All right, let's talk with Tom Essaye. Same conversation right now. The main driver of markets are central bank expectations and earnings, expecting that 25 or potentially 50 basis point reduction in the July meeting. Great to have you with me, Tom. What have you got to say about the macro picture?
Hi, Jill. Thank you very much for having me on. Yeah, it's a pretty muddled macro picture. I mean, right now, the market has fully priced in 25 basis points from the Fed next week. But before we get there, we first have to get past the ECB. Now, one of the things that's important for investors to realize is that stocks have rallied on the expectation of global easing, not just from the Fed, but from the ECB and then later other central banks. So the ECB needs to fulfill that expectation this week. If they don't, we could see some volatility Thursday and Friday.
Well, how concerned are you if we have no more tools in the tool chest should we get in that later cycle when a recession could potentially hit? It will at some point. These are all cycles. What if we don't have any more ammunition?
Yeah, I think that's a serious concern. And I think that you know, it's surprising to me, having gone through two recessions and traded through two recessions, that the market is so confident that this Fed rate cut, is going to be so different than the previous two, which was in 2000 and then 2007. Certainly, there are some positives that we did not have back then. I'm not saying it's the same situation. It's just that historically, Fed rate cuts haven't been met with the greatest market response 12 months out. It's surprising to me that markets are so confident this time around, and I think that is some vulnerability we need to consider.
All right, and just taking a look at your report from this morning, the S&P 500, we had our first down week in July as Fed, policy expectations continue to whipsaw. Now, we had a fantastic first half of the year. Do you think for the back half we're going to mirror that performance? I mean, 20% higher in the S&P, that's tough to mirror, but overall action, do you expect more volatility to come into the market? Because now we're going to start with the whole 2020 election rhetoric as well.
Well, that's right. I think so. I mean, how could we not expect some more volatility in the second half? I mean, the first half of the year was almost textbook perfect, right? There was very little volatility and stocks just kind of went up no matter what happened. Sure, I hope that happens the second half of the year. But in reality, we're in a market that's being driven now based on the expectation that the Fed is going to save us, right? The Fed is going to save us from a slowing economy, and it's going to prolong this expansion. And guess what? If that happens, hooray. It's just the last two times that we've had that expectation, again, in 2000 and 2007, didn't work out so well. So I just want people to pump the brakes a little bit on the sort of roaring optimism right now.
Right, because there is a lot of optimism baked into this market. And we're seeing that in asset prices right now. A 25 or 50 basis point cut, that's not enough when earnings have been, average at best so far for the quarter. We're eking out earnings beats, but the bottom lines have not been that strong. In fact, there's growth declining from last year. And you can't expect growth to be from the bottom of the chart to the top right every single quarter, but the beats haven't been that spectacular. I think there's just a lot of optimism baked into asset prices right now, predicated only on a rate cut. You would think now that we're in this thick of earnings season that we'd get back to fundamentals.
You would think so, but it's weird. It's like the Fed has almost become like a celebrity institution that people just look to them and they're like, oh, well, whatever the Fed does, it's going to make stocks go up or stocks go down. Certainly the Fed is a major player in the markets, especially in the shorter term. But you're absolutely right. We have declining earning expectations for 2020, right? We started the year expecting the S&P 500 to earn $185 a share next year. We're down to 178. That's not good, right? Because stocks at the end of the day are just expectations of future earnings. Now, people say it's okay because if the Fed cuts rates and the economy restarts and we get solid growth, then earning expectations should turn around. Certainly that can happen. But again, you're talking about a market that is fully priced, fully valued, regardless of metrics. And I just think people need to be a bit more cautious. Certainly we could see a continued rally, but it's not a sure thing. And the market's acting a bit like it's a sure thing.
All right, Tom, thanks so much for joining me. Great discussion as always, everybody. That's Tom Essaye, is the founder of the Sevens Report.